Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks, finance, and economics. I'm your host, Louis, and I'm excited to have you join us today. We've got a lot to cover, so let's get right into it. As we start the show, we're taking a look at the latest developments in the world of finance, and one story that caught our attention is the potential obstacle to rate cuts by the Federal Reserve. According to Mark Sumerlin, an economist and contender for the next Fed chair, the bond market could throw cold water on rate cuts. Sumerlin suggests that if the 10-year yield were to rise after a rate cut, the Fed would need to hit pause again. This is an interesting perspective, as it highlights the complex relationship between interest rates, the bond market, and the overall economy. On one hand, lower interest rates can stimulate economic growth by making borrowing cheaper. On the other hand, if the bond market reacts negatively to a rate cut, it could lead to higher long-term yields, which would offset the benefits of lower short-term rates. Sumerlin's comments come as President Trump continues to push for lower interest rates, despite concerns about inflation. The president has been vocal about his dissatisfaction with current Fed Chair Jerome Powell, and Sumerlin is one of the contenders being considered as a potential replacement. It's worth noting that the bond market is a key indicator of investor sentiment, and its reaction to a rate cut can have significant implications for the economy. If investors expect inflation to rise as a result of looser monetary policy, they may demand higher yields on long-term bonds, which could limit the effectiveness of rate cuts. As we explore this topic further, it's essential to consider multiple perspectives and avoid taking a biased view. The relationship between interest rates, the bond market, and the economy is complex, and there are valid arguments on both sides. We'll be keeping a close eye on developments in the world of finance and economics, and we'll bring you expert analysis and insights to help you navigate the risks and opportunities. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're joining us again for another segment of insightful analysis and expert commentary. Today, we're diving into a fascinating topic that has been making waves in the financial world, the potential stock market bubble. Now, I know what you're thinking. Bubble is a term that's often thrown around, but is it really justified this time? Let's take a closer look. According to Bank of America strategist Michael Hartnett, the S&P 500's price-to-book ratio has reached a record high of 5.3, surpassing even the dot-com levels of 2000. That's right, folks, we're talking about a valuation measure that's higher than it was during the infamous tech bubble. Now, some of you might be thinking, but Louis, this time it's different. AI is transforming the economy, and the profits are already showing up. And I get that. The potential of artificial intelligence to drive earnings growth is undeniable. However, Hartnett's warning, "It better be different this time," is a timely reminder that high valuations don't necessarily mean that stocks are in a bubble, but they do warrant caution. As we've seen throughout history, sometimes those expectations turn out to be too elevated and prices correct. So, what does this mean for investors? Well, if the market does start to unwind, Hartnett suggests that bonds and non-US stocks could benefit. Now, I want to emphasize that this is not a prediction of doom and gloom. The market is complex, and there are many factors at play, but it's essential to approach these valuations with a critical eye and consider the potential risks. As Rick Reeder, the chief investment officer of global fixed income at BlackRock, said earlier this week, the market is in the best investing environment ever, but that doesn't mean we should be complacent. So, what can you do? Well, for starters, it's crucial to maintain a diversified portfolio and not get too caught up in the hype. Consider funds like the iShares Core US Aggregate Bond ETF or the Vanguard FTSE All World ex-US ETF, which offer exposure to bonds and non-US stocks. And remember, valuations are just one piece of the puzzle. Keep an eye on earnings growth, interest rates, and other macroeconomic factors that can impact the market. In conclusion, While the potential stock market bubble is a topic worth exploring, it's essential to approach it with nuance and balance. We'll continue to monitor the situation and provide you with expert analysis and insights. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at the latest market news. The Dow Jones Industrial Average had an exciting day, reaching a new all-time intraday high before losing some steam and finishing nearly flat. This surge was partly fueled by none other than legendary investor Warren Buffett, who disclosed a significant stake in UnitedHealth Group through Berkshire Hathaway's quarterly filings. Now, let's take a step back and analyze what this means for investors. The Dow's brief record high is certainly noteworthy, but it's essential to consider the broader market context. The index's price-weighted nature makes it more sensitive to price movements, which can sometimes lead to divergences from other major indexes like the S&P 500 and Nasdaq Composite. It's also worth noting that UnitedHealth Group's substantial gain contributed significantly to the Dow's intraday high. However, the stock has experienced a decline of over 40% year-to-date, which raises questions about its long-term prospects. As we move forward, investors will be keeping a close eye on economic data and the Federal Reserve's next moves. With the annual Economic Symposium in Jackson Hole just around the corner, market participants are eager to hear from Fed Chair Jerome Powell and gauge the likelihood of another interest rate cut. In conclusion, today's market action serves as a reminder that investing is a complex and ever-evolving landscape. It's crucial to stay informed, consider multiple perspectives, and maintain a balanced approach to navigate the risks and opportunities that arise. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.